Okay, story time. My coworker Wendy literally turned down a raise last year because she said, and I quote, "If I make more money, I'll just end up in a higher tax bracket and actually make less after taxes." I stared at her. She stared at me. And then I realized she actually believed this, and she's not alone. This myth has convinced thousands of people to turn down raises, promotions, and opportunities because they think the tax system punishes you for making more money. So today, we're killing this myth once and for all. Let's talk about how tax brackets actually work. Welcome back to Paycheck to Progress. I'm Jenny. We've covered your pay stub, we found the $1,500 you were leaving on the table, and now we need to address the biggest financial myth that's keeping people broke. The idea that making more money somehow makes you poorer. This comes up every single time someone gets a raise, a promotion, or a bonus. And it needs to stop, because it's not true. It's never been true. And I'm going to show you exactly why. Here's what people think happens. Let's say you make $59,900 a year. You're in the 22% tax bracket. Cool. Then you get a raise to $60,500. Now you've crossed into the next tax bracket. Let's say it's 24%. And people think, oh no, now all my income gets taxed at 24% instead of 22%. I just lost money. This is the myth. And I get why people think this, because nobody actually explains how tax brackets work. Your HR person doesn't explain it. Your parents probably don't know. And Wendy from accounting is out here spreading misinformation like it's her job. So people literally turn down raises, they decline promotions, they work fewer hours, they leave money on the table, all because they think the tax system is designed to punish success. Plot twist. That's not how it works. Not even close. And the IRS, for once, isn't actually trying to screw you over here. The system is actually designed to be fair. Shocking, I know. But let me explain. Okay, here's how tax brackets actually work. And I'm going to use an analogy because the government's explanation makes zero sense. Imagine you have a series of buckets. Each bucket represents a tax bracket. When you earn money, you fill up the buckets in order. The first bucket gets filled first, then the second, then the third. Each bucket has a different tax rate, but, and this is the key, only the money in that specific bucket gets taxed at that bucket's rate. Let's use 2025 numbers for a single person. Bucket 1. 0 to $11,925. Tax rate, 10%. Bucket 2. $11,926 to $48,475. Tax rate, 12%. Bucket 3. $47,151 to $100,000. Tax rate, 22%. There are more buckets, but let's stick with these for now. So let's say you make $60,000. Here's what actually happens. First, you fill bucket 1 with $11,925. This gets taxed at 10%. That's $1,192.50 in taxes. Then, you fill bucket 2 with the next $36,550. That's from $11,926 to $48,475. This gets taxed at 12%. That's $4,386 in taxes. Then, you have $12,850 left over. That's from $47,151 to $60,000. This goes in bucket 3 and gets taxed at 22%. That's $2,827 in taxes. Add it up. 1,160 plus 4,266 plus 2,827 equals $8,253 total in federal income taxes. Your effective tax rate, the actual percentage of your income that goes to taxes, is about 13.8%. Not 22%. Not even close. Now let's say you get a raise and make $65,000. What happens? Do you suddenly pay 22% on all $65,000? No. You still pay 10% on the first $11,600. You still pay 12% on the next chunk. You still pay 22% on the next chunk. The only thing that changes is you now have an extra $5,000 that also gets taxed at 22%. So your additional tax on that $5,000 raise is $1,100, which means you take home $3,900 of that raise. You didn't lose money. You made more money. Just not the full $5,000 because yes, taxes exist. Now let's define two terms that people mix up constantly: marginal tax rate and effective tax rate. Your marginal tax rate is the rate on your last dollar earned. If you make $60,000, your marginal rate is 22% because the last chunk of your income falls in that bracket. This is the number people see on tax tables and freak out about. Your effective tax rate is the actual percentage of your total income that goes to taxes. This is always lower than your marginal rate because of the bucket system we just talked about. For someone making $60,000, it's around 13 to 14%. Here's why this matters. When Wendy says, "I'm in the 22% tax bracket," She thinks that means she pays 22% on everything. Wrong. She pays an average of 13 to 14% on everything. Her marginal rate is 22%, but her effective rate is way lower. This is why you never make less money by getting a raise. Because only the extra money gets taxed at the higher rate. The money you were already making stays in the same buckets at the same rates. Let's do one more example to really drive this home. Say you're making $99,000 and someone offers you a promotion to $105,000. You'd move from the 22% bracket to the 24% bracket? Should you turn it down? Absolutely not. Here's why. Your first $11,600 still gets taxed at 10%. Your next chunk still gets taxed at 12%. Your next chunk still gets taxed at 22%. Only the income over $100,000 gets taxed at 24%. So on that $6,000 raise, you'd pay 24% on $5,000, the amount over $100,000, which is $1,200 in tax. You keep $4,800. Is $4,800 more than $0? Yes. Yes, it is. Take the raise, Wendy. Now, are there scenarios where making more money can hurt you? Yes, but it's not because of tax brackets. It's because of benefit cliffs and phase-outs. Here are the real situations where more income can backfire. 1. Losing eligibility for government benefits. If you're getting subsidies for health insurance through the Affordable Care Act, earning more can reduce or eliminate those subsidies. Same with programs like SNAP, Medicaid, or housing assistance. These have hard cutoffs where $1 over the limit means you lose thousands in benefits. This is a real issue, and it's called the benefits cliff. But this isn't about tax brackets, it's about poorly designed government programs. 2. Student loan income-driven repayment plans. If you're on an income-driven plan, making more money increases your monthly payment. In some cases, this can result in paying more in loan payments than the raise gave you. Again, not tax brackets, it's loan repayment structure. 3. Retirement account contribution limits. If you make too much, you might not be able to contribute to a Roth IRA directly. You'd have to do a backdoor Roth. Not a huge deal, but it's an extra step. 4. Premium tax credit phase-outs. Make too much, and you lose credits for health insurance premiums. This is real, but again, not tax brackets. So yes, there are edge cases where earning more can reduce your benefits or eligibility for certain programs. But none of these are because of how tax brackets work. Tax brackets themselves never make you worse off for earning more. They just take a percentage of the additional income. If you're not on government assistance programs or income-driven student loan plans, taking a raise will always make you better off financially. Always. So why does this myth persist? A few reasons. 1. The tax code is deliberately confusing. The government could simplify this, but they don't. So people rely on word-of-mouth explanations from people like Wendy, who don't actually understand it. 2. People confuse marginal and effective rates. They see that they're in the 22% bracket and think they're paying 22% on everything. 3. Paycheck withholding can look weird. Sometimes when you get a raise, your employer withholds more than they need to from that first paycheck because they're trying to estimate your annual taxes. So people see a smaller bump than expected and think, see? I told you the taxes would eat it. But that's withholding, not actual tax liability. You get the over-withheld money back when you file your return. 4. There's a general distrust of the system. People are used to being screwed over, so when someone says, if you make more, the government takes it all, they believe it because it fits the narrative. Here's how to combat this. Learn the actual numbers. Look up the current tax brackets for your filing status. Calculate your effective rate. When someone tells you not to take a raise because of taxes, show them the math. Be the person in the room who actually knows how this works. And if you're Wendy, and you turn down a raise because of this, call your boss today and ask if that offer is still on the table. Because you just left money on the table for no reason. So here's your homework. Look up the current federal tax brackets. Figure out which bracket you're in, that's your marginal rate. Then calculate your effective rate by dividing your total tax paid by your total income. You'll see they're not the same number. And the next time someone offers you a raise, a promotion, more hours, a bonus, whatever, say yes. Because making more money will never result in you taking home less money due to tax brackets. That's not how the system works. Next week, we're diving into open enrollment, the annual event where you pretend to understand health insurance for 20 minutes and then click same as last year. We're breaking down how to actually choose between health plans when an HSA makes sense and why you need to stop ignoring this. Subscribe if you've ever believed the tax bracket myth. Like this video if you're now going to correct Wendy the next time she brings this up. And comment below. Has anyone ever told you not to take a raise because of taxes? Let's hear your stories. See you next week.